What's going on, guys? Brian's here. Today is Friday, September 24th, 2021. We're going to be taking an in-depth look at the market right now. So we'll be analyzing the S&P 500, both the ETF, so the SPY, as well as the ES futures. And then we'll be looking at the QQQ and the NASDAQ futures just to analyze tech in relation to the S&P 500. To kind of answer the big question, should you be participating or buying the dip in the market right now, or should you be looking to short this retracement? This video is going to be packed with a ton of technical analysis. So if there's anything in which I mentioned that you haven't heard of before, please leave a comment down below and I'll try to answer your questions, or I'll probably do a video addressing certain questions if I get a lot of them. Jumping right into it, let's start with a very simple tool that any trader has, and it's going to be the Fibonacci retracements. There's two things I want to point out. If we look at the swing high for the year to this most recent swing low, we'll see that what we had on the end of this week on Thursday and today, Friday, the market was able to hold over the 50% retracement. And the way this is used for anyone that has not used the Fibonacci retracement before, if you are a bear and you want to short the market and you like to wait for a retracement, you let it put in a new swing low and then you look to take the market short on a retracement. So in other words, this is the area that bears will be looking to short on either a 61% retracement or a 50% retracement. But the price action that we're seeing right now was very bullish towards the end of the week, and the bulls definitely had a lot to prove by holding it up here. What we have, this orange line right here, is the 50-day SMA. So we actually reclaimed the 50-day moving average on the daily time frame, which is of significance. If we just zoom out, we can actually see that the 50-day has held the market up pretty much for almost this entire year. This is the start of the year here. Anytime in which we've dipped below it, we did recover and then went on to put in new all-time highs. Now, there's a little bit of a difference here. I'll get into it later in the video, some key things I'm going to point out. But now that we know, or we have one perspective on the market for if you are a bear, let's take a look at if you are a bull, where would be a good clean place to probably catch the retracement. It would be down at this level here. So you can mark these levels off, pause the video if you haven't done this analysis yourself, or if you're just looking to get a different perspective. But if you're a patient trader and you don't like trading the momentum on the way up and you're looking for retracements to then go long, this in a sense would be the area to go long to potentially catch the next leg up. If you don't know, I'm more of a retracement trader, which is why I'm starting with the Fibonacci's, because I think it's very easy to see. It's not based on so much of a discretion or subjectivity. I'm literally using what we know to be the all-time high in the market with the most recent swing low. So it doesn't matter what platform or what system or style in which you trade, a 50% retracement is always going to be a 50% retracement. If we just zoom out again, next thing we want to take a look at here is how has the market reacted if we look at volume, because volume is something that's super important and we always want to pay attention to it. Here we had this insane volume spike on this low back in February. So if we take a look at, this was the volume spike and the market went on to push up from here. Here was another big volume spike which had put in this low, but the market continued up from here. Here was a volume spike on this low. Here was a volume spike on this low, and then here was the most recent volume spike on this low. So if the market is to continue with the pattern in which it's been putting in all year long, we should operate with the pretense that we're more than likely going to go back to the all-time highs, especially if we also look at how high the volume was here. And this has been the second highest volume in one day for the market so far this year. And we can see what ended up happening here. So it's one thing to take note of. And with trading, you need to look for multiple confluences to see if you can find different reasons, different clues, if you will, because while the market might appear to be random at certain times, we use technical analysis to try to bring some sort of order to the chaos that can seem to be completely random, and we're trying to spot certain patterns to create some sort of an edge for ourselves before we take our next position. I just switched over to the ES, so the S&P 500 futures, and the reason I'm switching over to the futures is because it pretty much runs 24/7 around the clock, and since we'll be looking at the volume profile, we'll be able to get a little bit more of an accurate read for the points of control as well as the value areas. And the ultimate question that we're trying to answer here is, should we be buying this dip that happened this week? Or in other words, should we trust this dip? We just looked at the SPY. We have a few reasons to believe the market will continue to be bullish. We're seeing what the bears may be thinking right now. This again was the retracement, so they are going to try and short this. We're going to be looking at some supply zones that formed in here. So let's jump straight into the volume profile and take a look. If this is your first time seeing this type of volume profile, I have a link in the description with this custom TOS study. So you can see it exactly the way on which I'm seeing it. Just make sure you set your chart to the 30-minute time frame. It doesn't matter how many days, but just make sure it's set to the 30-minute time frame. I go over in a previous video in which I explains the volume profile and how professional futures traders use it. The reason the 30-minute time frame is used is because it comes straight from the market profile, which is different from the volume profile. But just know the 30-minute time frame is the time frame in which you're going to want to use. And very briefly, I went over this in that video, but for some of you, this might be your first time seeing this type of content here. So I do want to point something out. Here we had the market was balanced during this week, but we can see the points of control. If you don't know, the blue area is what's called the value area. So this is where majority of all the volume traded for that day. And then the gold yellow line is what's called the point of control. So it's the price in which the most amount of shares, or in this case, futures contracts, were traded. Which is of significance, because think about this. If you go to the supermarket and you look to buy apples, and you know that the price for apples for that day was trading at $1.50, and it spent, you know, if there was 1,000 apples that were sold that day, and out of 1,000 apples, 800 of them was sold at the price of $1.50, that's going to be the point of control, because that's 80% of all the apples that were sold for that day were sold at that price. If there was an apple that was sold for $2, that's not going to be as significant as an apple sold for $1.50, because that can be considered an outlier, if anything, or it could have been a mistake, or, you know, you can think of it that way to simplify this, because this video isn't just on the volume profile. I can end up talking just 30 minutes just on that, but just know the value area and the points of control is significant. But if we continue just with that in mind, we can see here that the point of control was pretty balanced and steady, and then it was increasing, but then we had this pretty shocking drop. And the reason this was shocking is because if we take a look at the consolidation period from here, and we put a box over this right here, we can see that this was the lowest point of control at that time. And when price sold off, this point of control was actually below this previous point of control. Now that's pretty scary when you have some sort of a balancing area like this. You don't want to see the point of control move that drastically and actually take out the previous points of control, the previous lowest point of control. And in a sense, that initiated some of this selling that happened here, as we can see the value area continue to decrease, as well as the points of control. So if we just track that along, we can see the first shift in what happened was when we finally hit this bottom here, the point of control actually increased, and then we had this significant point of control increase here. But then we had another shock that happened right here. Again, the same reason this was shocking is because if we take a look at this week right here, which was pretty balanced, we can see that this was essentially where all the value was if we just draw a box around the whole thing. I'm also including the candlesticks and stuff, but disregarding the candlesticks, if we actually just look at the value area, it was actually from here all the way down to here. And this being our lowest point of control, this was last week Friday. We can see this point of control was below pretty much the balance area, as well as below the lowest point of control. That's pretty much going to shock a lot of traders, because that's not something that should happen, especially on a Friday. And then what ended up happening is, as we can see on this Monday, we had this crazy gap down. Even if it was a catalyst or news driven gap down, this video is not about the fundamentals behind things. We're just looking at things from a technical standpoint, analyzing price and volume. But we can see this severe gap down, as well as the drastic drop in the point of control. Now, for one thing, if you guys are new to looking at points of control and value areas and things like that, just know that the market is constantly self-correcting itself. So what I mean by that is, if this area right here, there was a lot of traders that bought this thinking they were getting the value, they were buying the dip or getting the market at a cheaper price, and then they woke up on Monday with price all the way down here, and this is going to cause a lot of traders to panic and stuff like that. But for the traders that do decide to hold, the market is going to come back up to this value area and essentially look to fill a lot of the orders here. In this region, whenever that happens, would come to be known as supply. The same thing as this area right here would be considered supply. So what we can see is the market eventually ended up coming back up. This was yesterday, and then this was today, but the market came back up to this area. And of course, the first time the price comes back up to here, it's going to sell. So that's what we're seeing right here. If this was our point of control, we can see this was just before the market had opened on Thursday. Sellers came in and they drove price back down. It might not have been people shorting. It would have just been people that bought on Friday, again, thinking they had a good deal last week. We're just happy to be able to get out for a break even, and that's going to cause this sort of selling. Now, as the market opened, real buying came in and actually drove price up. What's significant about looking at the volume profile is to understand the fact that this is pretty impressive for the bulls to be able to have 2 days where the point of control was over this from last week Friday. It's showing that there was actual real buying happening here. Even though there's a lot of supply in this region, we can see that the market looked very healthy towards the end of the week. This right here is a screenshot from a different platform. We were just looking at Thinkorswim, but this is the platform in which I use to trade futures. NinjaTrader, I highly recommend them. I think they're great, especially for their volume profile tool, because what we can do is, I can't do this in Thinkorswim, at least I don't know how, if it's even possible, but we can actually isolate the volume profile around certain regions. So in other words, this right here is the balancing area that I was talking about back here, and that would have been towards the end of August and the end of the first week of September. We had this balance, and looking at the point of control at that time was right here. So if you haven't checked out the previous video, this is actually where I entered my short, because I love taking retracements. It was a perfect retracement from here back up into this previous point of control from this consolidation area. It's pretty much a high probability trade almost every single time. But then what I did here is I then put the volume profile around last week's price action, so from September 13th to September 17th, and we can see this was the point of control for this whole consolidation period. And what ended up happening is the market came back up to this point of control yesterday and then today, and you guys can see that this area is acting as a little bit of supply, because again, it's anyone that was long during the mess last week is just happy. They want to get out of the market. They'd rather just close some of their positions. They're happy they didn't lose a ton of money because they didn't realize any of the losses down here. This is the perfect place for them to get out and then sit on the sidelines to see who's actually going to win next week. Will it be the Bulls, or will it be the Bears, or are we waiting for the next catalyst? Now, in I think 3 weeks or so, earnings season is actually going to start. So a lot of the tech stocks are going to report early. Netflix usually is the one that kicks things off. There's more than likely going to be a lot of cash on the side, people waiting to see how things go before deciding if they want to just wait until 2022 before actually coming back into the market. So I'm going to leave my opinion towards the end, what I actually think is more than likely going to happen. I'm trying to keep everything very objective right now and just pointing out some facts that anyone can see on their chart, but it's about understanding how to piece the information together. So this is pretty impressive. So far right now, things look really good for the bulls, other than the fact that this retracement right here is right in not only this supply area, but it's also in a place that bears are going to try to take short, because they know the risk reward is not that bad for a bear right now. If you're shorting the market anywhere and on around this price, you can have a stop loss essentially over here. And if this is your stop loss, you're looking for a target maybe back down to here, or potentially even down here. This is a great risk right here to make all this as your reward down here. So the risk reward is in favor for bears, but if bears are to lose the battle early next week, we're more than likely going to squeeze a little bit higher. Now, how high can the market go? Obviously, we can go back to all-time highs, but I don't think that's what's going to happen in a straight shot this time. If we jump back to Thinkorswim, I'm going to explain why. So I'm going to jump back, and now we're looking at the ES here. Let's actually jump back to the SPY, as I want to point a few things out. A little bit of a change in the characteristic right now. Let's zoom in, and let's actually plot some trend lines on our chart. So let's start with the regression trend line. So this is from the most significant dip. This is the highest volume from the year. This was our deepest low with the highest volume spike, or we can come to here. If I wish to just draw this out, this is the regression trend line, and we see where will the market want to come back up to, pretty much back up to this regression trend line, which would put us back at the all-time high. So that's a non-discretionary trend line. That's an algorithmic trend line. That's a formula behind that. But now we're going to use a little bit of just technical analysis, a little bit of intuition, and I'm going to draw out my own trend line, just looking at 2021's price action. And let's start by looking at this day right here, because again, this is significant to me because of how high the volume was right here. Let me just actually switch to this one, and let's just use the body. Let's start with that. I want to try and get as much touches as possible, and let's just move this right along here, and let's adjust that right there. We'll say this looks good for now, just eyeballing things for a bit. And then let's see if we go here, and let's actually include this because it had a lot of great touches right here. All right, so if we can say again, when it comes to drawing out trend lines, it's very discretionary. A little bit of subjectivity comes into play. The reason I'm using this one is because the volume spike right here, I'm essentially want to anchor a lot of the analysis moving forward from this day. And then the reason I chose to surpass this price action here is because I'm trying to get the most amount of touches on this trend line. And if I went with these up here, it then would have sliced too high over this, and then I would have missed a lot of, I want to try to align, you know, with some of the price action here. Again, not the most, maybe there's a million different, there's probably an infinite amount of ways to draw trend lines, which is why it's not going to be the core for a trade idea. It's just going to be something where we're looking to add some sort of confluence with. But I want you guys to see something here. The key takeaway, so obviously we were well above the trend line here, but again, we can draw another trend line and try to probably include some of that price action, but that's not the one in which I want to talk about. We're looking at this channel right here, and we can see obviously this channel held up pretty strong for the year so far. However, when we consolidated last week during here, you guys see now on Friday when we broke this channel, not only did we break the channel, but we were below the 50-day SMA on the daily right here. If I haven't mentioned it in this video, the orange right here is the 50-day moving average, and this is the 200 down here. So we closed, not only did we close below the 50-day, but it was the first real breakdown and close below this channel in which we had seen. And obviously that's also going to trigger a lot of selling pressure coming into the market. Again, from a technical standpoint, in this case, the catalyst usually always follows the technicals. It's not even, it's funny how, you know, you'll find a stock at support, and then whenever at support, this is usually when PR is released and we get some sort of a big push off of the level. And the same thing if we have a stock that's been trading at a range and then it's kind of struggling at resistance, then we get some breaking news that then drops the stock all the way back down to support. It's no coincidence that happens. But moving right along, what I want to point out that's different here is this is the first real breach of this channel. If we just zoom out for a second so you guys can see the channel, what it looks like on a broader spectrum, this is different for the market, right? So whenever price breaks out of a channel, it doesn't just hop right back into it right away. At most, if we get back up to it, it's going to consolidate below it for a bit and then try to pop into it. And what we already know is there's going to be a little bit of resistance here just because of this was the consolidation from last week. So between here and here, there's going to be a decent amount of supply. So not only does price have to deal with this overhead supply, we're going to have to deal with this resistance that's going to take a lot of buying pressure to come in. And then when it finally breaks this resistance, it's then going to have to deal with the buying pressure that has to supersede, or the demand has to supersede the supply to then push it back into this channel to allow it to come back up to here. So when you look at it from this perspective, it's going to take a lot of work, whereas the last time the market dipped, it was already still in the channel, so it wasn't really that hard or difficult to go back to all-time highs. The same thing here, we dropped off, we hit the 50-day SMA, and then before you know, we were back at all-time highs. It didn't have to get back into the channel. Same thing here, it didn't have to get back into the channel, and so forth. So understanding how that is different is one of the reasons why, for me, I'll save a little bit of the answer, my complete answer. If you want to know, I'm cautiously bullish. I'm a retracement trader, so ideally I would want the 50% retracement to then go long to here. How I'm going to approach the market next week, I'm more than likely going to open up some sort of iron condor, and I'm going to be looking at some sort of range like this, as I think the market will have a little bit more trouble going higher. Even though I do believe it will be going higher, I do think it's going to take a little bit more time to get back into this range, and then before you know it, if any sort of bad news or anything comes out, I do think we'll come right back into this range. So I'm going to give it a little bit less room to the upside, probably more room to the downside. Again, things may change by Monday morning. By the time the market opens, I'm probably going to be looking to open an iron condor at 10:30 a.m. The iron condor, by the way, if you don't know, it's just an option strategy that means you pretty much profit if the price stays within a range by expiration. So that's my answer. Again, ruining a little bit of my approach. I was going to save it for the exact end, but I want you guys from now to understand why I'm thinking this is because most people might be thinking, oh, you know, just buy the dip or just keep buying, and then we're going to, before you know it, the market's going to be at all-time highs. Not understanding the context in which we're in, it's going to take a lot more buying pressure for that to happen. And not to mention, if we take a look at the retracements that have happened all year long, we had a beautiful 50% retracement right here. If we delete that, we had from here to this was our high. We had another 50% retracement that happened right there. If we come, this was our swing low to swing high. Again, another 50% retracement. And remove that, and so forth and so forth and so forth. 50% retracement. This was around a 61% retracement, but ultimately I think the 50% retracement, if we just draw it out actually so you guys can just see it. So from here to here, yep, see 61% retracement. This was the 50 retracement, held and pushed us to new all-time highs again. But now if we take a look at the most recent, here was our most recent swing low, here was our swing high, this was our 50% retracement, and this is also the confluence with the trend line. You can see why there was a lot of fighting going on. The bulls were really trying to hold price up here before ultimately price broke down. Now this is a full 100% retracement from this level. So we went all the way up here and then we came all the way back down. This is not necessary. This hasn't really happened so far for the year. And then even if we were to take this as our swing low and we draw this up to the swing high, we came, not only did we get down below this 50% retracement, but look at how deep of a retracement this was. We haven't had this level of penetration in terms of a retracement level so far, or at least in a long time. And this would have been the last real deep retracement from here to here. It was almost 100% retracement because price almost came back to this level here, in which it didn't. Buyers ultimately ended up coming in and stepping in and holding price up, at least on the SPY. I'm not sure if on the futures, if we ended up coming down to this level, but we have to take note of the change in pattern, and this is a little bit of a difference, and that's exactly why I think selling options right now, or selling calls for all-time highs, and obviously, you know, doing some sort of vertical spread is pretty a better time now to be doing it versus anyone that tried to sell calls during this time. You probably ended up getting, you know, having to stop out or close the trade pretty soon, because price only took 3 days here to get back to all-time highs. It took 4 days here. It took 4 or 5 days here. I don't think that's going to happen this time, and I do think it's going to take a decent amount of time, which is perfect for option selling. Now, if we remove this resistance line, let's also remove this channel, and now let's just take a look at things from a trend line perspective. Let's actually go to a shorter time frame. So this is the hourly time frame. If we take a look from the all-time highs down here, we have this trend line right here. So the market also has to deal with breaking through this downward trend, because we're technically still in a downtrend, because this is a lower high, and we still have to come back up here. Price needs to break past this. So we're dealing with this downtrend. We're dealing with this supply area that was formed here. We're dealing with getting back into the macro channel. So there's a lot of convergence. We can say around 450. And I'm pretty sure if you check the options chain, the highest open interest is going to be 450, because that's the market makers selling a ton of the 450 calls, more than likely knowing that the market is going to struggle to close over $450. Moving right along, we're going to conclude on the NASDAQ. But before we do, let's actually just throw on the 20-day moving average, because that's also of significance. And I do want to point out that the fact that we struggled last week to get over the 20 was pretty significant, but now we're stuck between the 50-day and the 20-day. So the market also has to get back over the 20-day. So there's just a lot of signs again here. So if you're going to be bullish, please don't be the bull that's just screaming, oh, the market's just going to bounce straight shot back up. While that may be possible, because first of all, anything's possible, it's not as likely as the last times, because there's a lot more signs that say it's not. And the market makers know this. They know everyone's eager to keep buying the dip because it's 2021. There's this perception out there that Jerome Powell is printing all this money and the Fed is just constantly printing all this money and XYZ. Keep in mind that things are different now, and the market makers know this. So it's easy for them to take advantage of retail traders and sell a ton of calls that may work, but you need to be cautious with it. Have a game plan for how you're going to hedge the positions in which you buy. And also take note of while we may get over 450, will we stay over 450, or how long will it take for us to get over 450? If you're an options trader and it takes a whole month to get over 450 and you're buying calls that expire in 3 weeks, you're not really going to make that much money, because you're going to lose so much on time decay. So now let's just wrap up with the Qs. And the Qs is already over the 50-day moving average and also below the 20-day. I'm going to remove the 20-day just to keep things simple. For the most part, I like to just keep the two main ones, and I'll just turn that on occasionally to check to gauge momentum. I have the VPOX. So the VPOX is the virgin points of control. If we just jump to this is just the virgin point of control, means it's a point of control in which has not been touched since that day. So I have these marked off from my chart. Same thing. Here was a virgin point of control. We can see on Thursday, price came right up to this virgin point of control, and then bulls were able to show that they were pretty strong on Thursday and Friday. We did have a little bit of a gap down in the point of control today by the close on Friday, but at the end of the day, we end up coming back up to yesterday's point of control. So this is no longer a virgin point of control. So that's why I removed the V there. If the market was to pull back, this is the virgin point of control in which I would be looking to get long anywhere between this virgin point of control and this point of control, which was touched on this day here. So if you ask me, between, we'll say 366 and 369 would be considered my demand zone or buy zone for the for the QQQ. And if we take a look at this right here, here goes our Fibonacci, here goes our 50% retracement to our 61% retracement. So where does that line up with? 366. This would be the sweet spot for me. So anything between here I would consider to be a deal, especially if we get some sort of volume increase like this, and buying pressure is showing, we can clearly see that buyers are defending these levels. Then I will definitely be looking to join them to then swing calls naked up to potentially this point of control here, assuming we don't hit this point of control or this virgin point of control early next week. If we remove that and we jump back at the larger time frame, let's do something similar in which we did on the SPY, and let's just start with the regression trend line. We're going to use this day right here and see. So if we were to get back to this regression trend line, that kind of puts us back at all-time highs. Remove that, and now let's try to draw out our own channel. So I'm going to use this same day here. I'm going to use this day because you see this was the day with the highest volume. I'm going to start with the lower end of this right here. I want to try and touch as many of these days as possible. So touching all of these here, coming right up. Let's see how this looks right here. Nope, we're missing out on this. So I'm just trying to adjust it and try to get as much of touches there. And then let's just move this right along right here, we'll say, and here goes our channel. So here's a channel on the Qs, and what we can see right here is deeper, wider channel, yes, but price is still in the channel. So tech stocks are still relatively strong. They're still in this nice uptrend, even though we're in this short-term downtrend. Just like the SPY, the Nasdaq has to fight with getting over this level, potentially get over it, retrace, and then push higher. So there is going to be a little bit of pressure because of this downward trend line. But then same thing like the SPY, even though it doesn't need to get back into its channel since it's already in one, it has to deal with this overhead supply, this virgin point of control, as well as this midpoint of the channel right here. So price will more than likely price will more than likely just end up riding along the channel, as we can see right here. This is the type of price action in which we see. You guys see how this took, oops, I accidentally erased the channel. Let me just draw this back for a second. Sorry about that. I pressed like the undo button on Thinkorswim and it ended up erasing it. So let's just draw this right here. And I believe it was something like that right there, right? So what I was pointing out is this took 1, 2, 3, 4, 5, 6, 7, pretty much 8 days to really reclaim this. So we can say about a week and a half of trading days. That's the type of, if assuming we have a huge Monday, how likely do you think it is that the market will then just really rally for the whole week? And even if it did, to be honest, I would not trust that rally. It's easier to trust it in tech than it would be than if it was the SPY, but tech can do that. It does it frequently, but it's not what in my opinion, what I would consider to be a healthy run. We do want to see consolidation. Consolidation is usually good. We do want to see a balanced market or so for a week. So I'm not going to be running an iron condor on tech. I'm going to keep my iron condors to the SPX, the SPY, and then I will be trading the futures if I'm looking to just, scalp the momentum in either direction. But hopefully this video shed some light on some things for you guys. If we just jump to a smaller time frame here, let's actually remove the channel. Here goes our 30-minute time frame. Same thing. You guys can pause the screen if there's anything here of good content for you guys, if you guys want to mark the levels. And then if we jump to the hourly time frame, I want to point out the volume that came in here would have been right on this day right here. So during this whole trading session right here, a lot of supply. We know this would have been formed in this area because we can clearly see it on the chart. So this is the level. I think the Qs are going to struggle between 378, 379, call it all the way up to 380, and then if we get up to this level, I'll more than likely probably be opening some sort of bear call spreads, which means I'll be selling probably all-time high calls and hedging it with 2 strikes up or something like that. And then maybe up here I might open up an iron condor with a lot more room to the downside with a little bit of room to the upside, because I think the risk reward will be worth it. Unless, of course, it's too close to earnings season and it looks like, tech stocks are just going to just blast off through earnings. And now to wrap up, let's just take a look at the Anchored View app. I haven't mentioned the Trading Views Anchored View app on this channel in a while, but I want to show you guys, if we just anchor the Anchored View app from this major swing low, if we start with the all-time high, you guys can see we actually closed over this Anchored View app from here, which again, very impressive that the fact that bulls are able to do that. If we bring this to here, we can see we're still a little bit below here, but this is not as significant. Let's bring it all the way down here to this swing low. We're over this area here. And then if we go to the most recent swing low, this is the retracement. It's probably all going to converge in the same area. 50% retracement from this move to here is probably going to be where the Anchored VWAP is, as well as the previous points of control. All that type of stuff usually ends up converging in the same area. And that's for the ideal scenario as a bull. This is really, really where I want to get long down here. And if we jump back to this, we can see this is where there was a ton of volume right here. It wasn't a point of control, but we can see that there was a decent amount of convergence in volume on the ES at this level here. So between here and here on the ES, I'm going to be looking to be potentially buying if things look good. So let me know if you guys want to see any more just technical analysis breakdowns on the broader markets like this. I love analyzing the ES. I love analyzing the NASDAQ. And if there's a decent amount of interest in this, I'll make this more of a frequent thing, probably once a week or once every other week or so, to really bring you guys up to speed so you can follow along the story of how I'm reading the volume profiles, as well as where I'm getting my levels from and how I'm coming up with my trade ideas. Leave a comment down below. Please like the video, share it if you learned anything, and subscribe to the channel if you aren't already subscribed. Link to my Discord is in the description down below. There is a public section and there's a premium section. You don't have to pay for the premium section. If you do want to chat with me, you can join the Discord. You can post in the public section or shoot me any. You can post in the public section or shoot me any DMs if you have any questions, or contact me on Instagram. Links to all my social medias in the description down below. Thanks for watching, guys, and I'll catch you guys on the next one.